given the rally that we've seen, given the epic performance we've seen from stocks this week, is it time to stock up? If you are behind this rally, do you need to chase it? Bilal Hafeez, Hive CEO and founder, joining me now here on set. Bilal, that's the question. Time to stock up?
I would say yes, but reluctantly. I mean, I hate to buy at these levels, but I think the underlying fundamentals are strong enough for this rally to continue. So one is that the economy in general is doing okay, hasn't fallen off a cliff. The household sector in the US stays strong. And we have this AI boom right now, which I think has further legs to go.
Bilal, I feel like, though, when someone says reluctantly yes, that's like the definition of a crash up, and you do the opposite.
Maybe, yeah, so maybe do the opposite. But, I mean, one thing I would say is when I speak to investors, and we speak to some of the, the smartest investors around, they just haven't participated in this move up. And what we have seen is, if you look at the drivers of this move up recently in the S&P, a lot of it is driven by the big tech names, so eight or nine companies. It hasn't really spread out amongst the rest of the S&P 500, so you could see a broadening out.
It's starting to.
It's starting to,
yeah. This week,
yeah.
Two best sectors, tech and consumer services, then industrials.
Exactly. So I think this is the phase where it starts to broaden out, and that gives us further legs up in the overall story. Now, if every stock had gone up massively, and if every company's valuation had gone up, then I'd be more reluctant. But given that it's very concentrated, I think there's more scope for it to broaden out to other sectors. But more generally, I think that the Fed is signaling that they're pretty much on hold. They may do one more hike, so you don't get much headwinds from that side. Yep. And there is this AI boom, which every company I speak to, and we're developing some of these AI tools as well, and client after client is saying we want to see it now. Mm-hmm. We have budget, we want to invest, we want to do something. So, I mean, this is much more pervasive than, say, crypto, which was kind of an interesting side thing. But this is every company is being tasked with integrating AI into their systems somehow, and this has further legs to go as a result.
Do you like Europe?
I do. I think the European story overall is good.
There's a but there. I can hear it. ...
There is a but. I think the main but there is that the recent run of European growth numbers have been quite weak, number one. Obviously, we still have the China side as well, where we're hoping that the stimulus will help the growth story pick up there. So I think there are some... I think it relies a lot more on the China pickup than anything else. And also, you're starting to see a pickup in energy prices within Europe as well. So there are some kind of areas of concern, but broadly speaking, I think the European stock story still is positive, but I'd favour the US over Europe.
Michael Hartnett over at Bank of America, talking about the fact that we do have a rally on our hands and it has legs, but ultimately it is going to break lower at some point. We're not in a shiny new bull market. Do you think we're in a shiny new bull market, or is this still a head fake?
I think ultimately will be a head fake, because I think that eventually the Fed will end up raising rates high enough to end all of this. The question is when that will be, and it may not necessarily be this year. It could be early next year where that happens. So for me, it's really a dance between the Fed and stocks. And right now, the Fed is basically saying, we aren't so concerned about inflation. We care more about labor market and just allowing time to solve all the problems. And so that gives us a runway for 3 months at least, or maybe 6 months even, where stocks could continue to rally.
So this is the fun part. So I want to talk about the ECB in Europe, and Guy wants to talk about US and Fed. But so to the ECB in Europe, you mentioned that you think the ECB could actually hike another 100 bips. I mean, what does that wind up doing then to the economy and then a bid for European equities? That feels like that would be really negative.
Yeah, I mean, when they do get to those levels, then it could be negative. But you have to remember the reason why they're hiking is because the underlying economy is doing quite well. So there's always this sort of, push and pull that we have to recognize there. And the other issue with the ECB is if you look at, how markets have traded around the Fed, the market's been constantly trying to fade the Fed. So if the same thing happens with the ECB, where they hike 25 and the market tries to fade that and price easings, that constantly happens, then it may not necessarily be so negative for risk. So the question then is the ECB going to be more aggressive in its language to say we're going to go 100 and we're not going to cut thereafter, and don't allow the market to cut rates? So that's really the dilemma for equity markets.
I guess, Alex, coming back to kind of, you want to talk about the ECB and I want to talk about the Fed. I think ultimately they do, though, face the same problem, which is that if risk assets keep rallying, and I think this is less of an effect in Europe just because of the way that people hold assets, but if assets keep rallying, then in theory, the transmission effect is lower and slower. And as a result of which, maybe the Fed at some point almost explicitly has to break the stock market in order to get the message across that spending needs to come down.
Yeah, but
the link with the labour market is beginning to be broken, actually.
Well, but I would say the opposite in that you can have stocks going up, but yields are also going up. I think if there was a bid into the bond market and the equity market, then I can see a really big increase in financial conditions are loosening. But otherwise, maybe this is just unfolding the soft landing and the Goldilocks scenario that the Fed was kind of painting before. Bilal, what do you think?
Well, I mean, for me, if you just step back and look at how all these different markets and financial conditions have behaved since the Fed started raising rates. So the Fed started to raise rates in March of last year, and up until today. So today, stock markets are pretty much the same level as they were back in March last year. House prices are higher,
which is amazing.
Exactly, and the unemployment rate is lower than back then. Households feel richer to back then. So that tells me that these hikes just haven't bitten the economy yet.
Is the Fed going to have to break the stock market?
It will. In the end, it will have to, because I think they don't quite recognize that the transmission, as you alluded to there, the transmission from rates to the household sector has been much, much weaker than before. Yeah. And that's partly because the US, people have long-dated mortgages and everyone refinance at very low rates. And so essentially it hasn't bitten them yet. So they have to go even more in order to bring the household sector down.
But Guy, this goes back to something we've been talking about in terms of the housing effect and the wealth effect. Does that have to go away? Who's going to move if you have a sub 3% 30-year fix? Not me.
Well, no, I appreciate that, and that is why transmission is working much more slowly than we would all anticipated. Lagarde was talking about this yesterday as well. She talks about the fact that it's transmitting to the loan market, but it's then not transmitting as quickly to the real economy. And this is where the problem lies. If you look at how many people actually have mortgages as well, then that's actually a significantly lower number than you would anticipate. So transmission is happening more slowly. So maybe actually central banks need to maybe go higher and go longer in what they're doing. And I think that could be maybe the other challenge, Bilal, in all of this is the fact that rates are going to have to stay higher for longer. We all anticipate that we're going to see rates coming down. Have we got past the idea that the Fed's going to be cutting anytime soon?
I think we should get past that, because I think for me it's just very unlikely they're going to cut anytime soon. And they're trying to hint at that in the most recent Fed meeting. They aren't but the stronger message would be for them to have hiked, because everything they said was the dots have gone up, everything looks much higher, but they didn't hike, which was odd. But I think all the data tells you that they just have to hike. This easings that priced into the market just make no sense.
So the final question I always ask Bilal is cash. You have been a big proponent of cash. Just very briefly, should you still be a big proponent?
I still like cash. Cash makes a lot of sense. You're earning close to 5% now, 5.5%, and I think that preserves your capital. And I think that people are generally underweight cash in many ways. So I still like cash.
Great to see you in the studio. Thanks for joining us on a Friday. We really appreciate it. Bilal Hafeez, Macro Hive CEO and founder. This is Bloomberg.